Today, we're going to talk about options basics, and we're going to talk about cash secure puts a little bit. We're going to hit cash secure puts, and we're going to talk a little bit more about options basics. Brokerage account requirements. You must be able to trade options. You need to check to see if you got an options level. Anytime you open a brokerage, it automatically comes with the ability to trade shares, to buy shares, to sell shares. That automatically comes with it. But if you want to be able to do options, you need to go a little deeper and get your options and get the options done. All right. You need to go and sign up for options or request options, whatever. So when you're when you're desiring to do options, they're going to ask you some questions. When you say, I would like to be able to trade options, they're going to ask you some questions. They're going to ask you questions like, what is your net worth? What is your knowledge level? Like liquid assets do you have? They're going to ask you some questions about yourself. So just know they don't necessarily, I'll say they don't necessarily care. They're more so looking out for themselves. Do with that information what you will. But you need to have the level you need to have a margin account. I have that here. You need to have a margin account. And you must have the option level for spreads. If you'd like to go to spreads, which after I teach it, you're probably going to want to do spreads. But you're going to need to be able to trade options. You need the approval for options. You need to have a margin account, not just, regular. Many people have cash account and margin. If you got Thinkorswim, you can have both. Some people have their IRA they're trading in. The IRA can be a margin account, that's no problem. But when you're in your IRA trading, you can't pull that money out unless you want to face tax implications or you're at the age where it doesn't impact you. If you have just a regular margin account, then it's susceptible to whatever taxes go with that. That's up to you what you decide you're going to choose. All right. And you must have the option level for spreads, which for, I think, Thinkorswim, that may be a level 2. And for TradeStation, it might be 3, but that may be backwards. But you need more than a level 1. All right. You need more than a level 1 if you're going to. What is a margin account and what is an option spread? So a margin account is the account that allows you to be able to utilize the margin money from the broker. If you have a margin account, generally you might have heard the phrase margin call. Somebody says, I had a margin call. So that means if you have a certain amount of money in your account, the broker will give you 3 times or 4 times your money to be able to trade with. So that means if you want to do more things than what your money allows, the broker will lend you money on margin. But margin accounts are required in order to do selling related things, unless you're going to secure it with your cash. And we'll talk a little more about that as we go. But you need to have a margin account if you're going to do selling. If you're going to do selling or spreads. Spreads is credit spreads and debit spreads. That's what I mean by spreads. Vertical spreads. Okay. Now we talk a little bit about buying and selling, what direction we're looking at when we're buying and selling. Okay. So last week we mentioned some things about buying and selling. If you're going to buy a call, if you're buying a call, you're expecting the price to rise. If you're buying a call, you're expecting the price to rise. If you're buying a put, you're expecting the price to fall. Buying a call, you're expecting price to go up. Buying a put, expecting price to go down. When you're selling a call, which is the opposite of buying one, you're expecting the price to go down or stay flat. If you're selling a put, you're expecting price to stay flat or to go up. Okay, this may feel a little confusing now, but as you get deeper into it, it may not be as confusing. If you're somebody who's already been a buyer, if you've already been buying options, selling is the exact opposite. If you're somebody who hasn't been buying options, if you're new to options, then just consider the selling piece. I'm going to take us down the selling path, okay? When you're buying a call or selling a put, you're expecting the price to go up. When you buy a put or sell a call, you're expecting the price to go down. Okay, these are graphics that will show back up again later. Selling versus buying options. When you're opening and closing a contract. So when you're opening, anytime you are creating or starting a new contract, when you're creating or starting a new contract, you are opening. That's called opening. You can buy to open or you can sell to open. Buy to open or sell to open. What we do here is we sell to open more than we buy to open, but you can do both, right? And when you're closing it, anytime you're ending a contract, then you're closing it, right? I think we can understand this terminology. When you're at a business, when you first get there, you open it. And at the end of the day, you close it. That's the same concept, right? Okay. So you can sell to close. So if you buy to open, you're going to sell to close. If you sell to open, you're going to buy to close. You're doing the opposite of what you did to open. So if you bought and open, you're going to sell to close. If you do a sale to open, you're going to have to buy to close it. Or for a good thing, either one of these can expire on their own. Sometimes you may not want it to expire depending on if you're in the money or not. And that's a different level of discussion. But why should you be a seller? We talked about buying versus selling. In our community, I'm a seller coach. I teach the selling options. And why should you be a seller? Well, when you're selling, you're almost like the house. You're like the house, or you're like the lottery people, right? You are going to be in more situations than not. You've got the opportunity to profit. There's more ways to win when you're a seller. To win these trades, you can win in 3 situations. If the price moves in your desired direction, so if you're thinking the price is going to go up and it does go up, then you're going to win that trade. If the price doesn't go anywhere, if it just sits wherever it was when you entered the trade, then you're going to win your trade that way too. Even if price moves back towards your strike some, but doesn't go past your strike, you're still going to win. There's 3 opportunities to win when you're a seller. When you're a buyer, though, if you're buying calls and you're expecting price to go up, the price has to go up. It has to keep moving. Otherwise, if it just sits still, you're losing money. If you're buying puts, which means you're expecting price to go down. If the price doesn't go down, or if it go down some and just sit there, you're losing money. Unlike selling, the price can move a little bit, move no bits. It's fine. You can still be winning. As long as it doesn't come back past your strike, then you are in a winning situation. 3 ways to win when you are a seller. 3 ways to win when you're a seller. When you're a seller, you're going to collect money when you enter the trade. When you're a buyer, you got to pay to play. You got to pay to play. But when you're a seller, you enter those trades and they give you money. They give you money right when you enter those trades. This is good. I like to be paid to play instead of having to pay to play. That works for me. When you find your desired strike, you receive your premiums immediately after entering this trade. Soon as you sell to open, the money is given to you right away. You keep this money when you win the trade. As long as the trade expires, out of the money, you will keep the money that you were given on entry. Or you can buy your way out. Let's say you sell for $20, you sell to open and you get a premium of $20 and it goes down to $5 and you buy back at $5. Well, if you sold for $20 and you pay $5, that means the $15 is yours to keep. If you sold something for $20 and then went and bought again for $5, then you're the ones who kept the profits of the $15. That's the way that works. As a seller, that's the process. Let's talk about our first strategy. Cash secure puts. Has anybody ever heard of selling puts? So let's talk about what selling puts is and what it includes. Selling puts is probably, I would say it is. Selling puts is the simplest of the option selling strategies. And not only is it the simplest, I call it a no-lose strategy, as you see on that first line. I call it no-lose because you're going to get something, no matter how this trade plays out, you're going to get something. All right? It's a bullish or a neutral strategy. Bullish means you're expecting price to go up. You're expecting price to go up when you are selling cash secure puts. It's either bullish or neutral. So it's either going up or it's staying flat. Both of those, fine with us. No lose strategy, because when you enter this trade, you receive premiums. When you enter the trade, you get premiums. When the trade is over, you either keep your premiums. If it ends, out of the money, you keep your premiums, or you have premiums and 100 shares. I'm leaving here with something. You're leaving here with something. You collect the premium when you enter the trade, which is your max profit. So you enter these trades, you get a premium. The trade does its thing. If the price stays above your strike price that you pick, then you get to keep your premiums. If price goes below your strike price and you're still in the trade at expiration, then they're going to give you 100 shares. Remember, every options contract includes 100 shares. Every options contract includes 100 shares. This strategy is used when people want to acquire shares at a desired price, right? Or to generate income. Some people just use it to generate income. They don't plan on getting the shares. They don't want to get the shares. They just want to get income off of it. That can be used for either or both of these methods. Here is the star here. This strategy should be used only on stocks that you want to own, or at least you don't mind owning. This is a strategy that you do on stocks that you really like. I'm going to do an example on SoFi, right? So I'm going to do an example on SoFi. That's a stock that many people would like to own. This is where you would do it. Now, if there's something else that maybe you're like, if I don't really want that stock, then don't use puts on it, right? Don't use puts on something, on a stock. Don't sell puts on something if the stock is not something you wouldn't mind owning, right? The opportunity for you to own it is not high, but it's there. It's not high, but it's there. So if you end up with these shares, you want it to be something you want. When do we want to sell puts? We want to sell puts when we want to acquire some shares at a lower price than they are currently. Because if you wanted 100 shares at the current price, you could just buy them where they are. You sell puts if you want to buy the stock when it's lower, right? You sell puts when you want to capitalize off of bullish movement as a seller. Bullish movement meaning going up. When you want to capitalize off of some upwards movement as a seller, that's when you sell puts. Okay, you do cash secured puts. Why do you think we call them cash secured puts? They're called cash secured puts because your cash is what secures this trade. Your collateral is what secures this trade. Now, cash secure puts can be done in a cash account. As long as the money that you need for the trade is in that same account, you can do this in a cash account. Remember, I was talking about needing a margin account. You can do cash secure puts in a cash account as long as the cash is in that account. How do we sell puts? You're basically going to select the strike that's at or below your current price, at or below the current price of the stock. Remember, strike price is on our option chain. This is the piece that's important. How much does it cost to do these trades? People always want to know, how much is it going to cost to do these strategies? Well, the collateral required is the strike price times 100 because we're talking about 100 shares. Strike price times 100. So if we're talking about SoFi, for example, and you want to use the 15 strike, I think SoFi is at 15.30 or something, it closed today. Let's say you decided you wanted to do the 15 strike. You're like, I'll do strike of 15, right? I'm willing, what this says is, I'm willing, if the price closes below my 15 by expiration, I'm willing to take on 100 shares at $15 each. That's why I said pick the strike price at the place you wouldn't mind owning the share, at the price you wouldn't mind owning the share. The 15 strike times the 100, I told you that because it's 100 shares in there, times 100 is $1,500. This is the collateral requirement for one contract of SoFi at the 15 strike. Of course, if we have a stock that has, if we pick the 6 strike on a stock, yep, let's say we pick the 6 strike, then we're going to multiply that times 100, and the collateral required will be $600. Now, collateral required is the broker is going to just block away that buying power. They're not going to take the money. They're going to block away that buying power until the trade is done. This is where that margin money can sometimes come in handy, right? You got enough in there, but if you want to be able to do these kind of trades, that you say, okay, they're going to block away $600 of my buying power until this trade is turned off. If you got a 15 strike, $1,500. Of course, we can go from here. 12 strike, multiply times 100. That particular one is going to require $1,200. So if you say, okay, well, I like this concept, but I want to do it on something that's, what's Palantir is what, $64? Palantir somewhere up there. I'm not actually sure where Palantir is today. That might be at 68. Anyway, that's not the point. 64 is your strike price you're looking at. You say, okay, I want to sell puts at the 64 strike price. Multiply that times 100. The broker is going to block away 6,400 of your collateral. That's how cash secure puts, that's the money of the cash secure puts. Okay, it's whatever strike price you select times 100. Okay, so you don't need to own the shares to sell the open. To open the cash secure puts, you just need the cash in your account. Selling puts means you just need the cash to secure it, right? You don't need the shares. So selling puts, it's an upwards movement. You believe the price is going to go up or it's going to stay flat. You say, I want to, sell puts on, I'm going to use SoFi again. If you want to sell puts on SoFi, maybe you say, okay, I'm going to sell puts on SoFi and I'm willing to pay $14 per share, or I want to pay $14 per share for them. It's at 15 and some change, but you're thinking maybe they'll come back down to $14 and I can get me 100 shares. You pick the 14 strike. The 14 strike in the option chain. You're going to have to multiply that times the 100 shares. $14 is what I'm willing to pay per share times 100 shares means the collateral the broker is going to require from me is $1,400. 14 times 100. That means the broker is going to take my buying power like a deposit. They're going to hold my money like they do you if you are going to rent you a car. They block off some of your credit card money until you bring their car back. This is the same situation. They're saying, okay, while this trade is running, we're going to keep this $1,400 off to the side. And the reason they do that is that if the trade expires and the price is less than $14 and you're still in the trade, they're going to use this $14 to buy the shares and give them to you. Okay, they're going to use the shares and they're going to use that money and give you the shares. All right. The broker is blocking away your deposit money like at the rental car place. Or when you get hotels, they block off another $100 for incidentals, they say. All right. Focus, Arlissa, focus. So you win the trade if the price stays above your strike at expiration. Again, this can be done in a cash account. As long as the price is above that 14, if you had the 14 strike and price expires on Friday above 14, if your trade is still open, then you get to keep the premiums. You keep the premiums that you earned that you got when you first entered the trade. We're going to do an example. You'll be able to see a little bit closer what I'm talking about. If price expires below your strike, so let's say we had the 14 strike, right? If the price expires below your 14 and you're still in the trade, then 100 shares will be put into your account at the $14 price. At $14, this is an at symbol, $14 per share. Okay, because that's the strike price you selected, and you were saying, if I stay here and the price is below 14, I'm willing to receive these shares for $14 a piece. So that's what happens with your with cash secure puts. All right, if price stays above your strike, you get to keep the premiums that you took in at the beginning. If the price expires and it's below your strike price, you're going to be put the shares. They're going to give you the shares, which is not a bad thing, because after that, what you do is the covered calls, which a few questions are coming up about whether or not you have to have the shares. Once you get these 100, if you were to get these 100 shares, then you sell covered calls against those. Basically, you have another selling strategy to help you capitalize off your asset of your 100 shares. Okay, because the 100 shares are an asset. Options contracts are not assets. Shares are assets. That means you at least are part owner of the company. An options contract doesn't mean you own shiggity. You don't own nothing but a piece of paper, an electronic piece of paper. That's all you own. Okay. The pros to selling puts. There's some pluses, right? It's very passive. And I say it's very passive. It's very passive. And it's very passive from the standpoint of, once you enter these trades, you really can let them run to expiration, right? You can let it run for expiration to say, okay, if it expires above my strike, they're going to release my buying power, right? That 1,400 that they had blocked away, they're going to give it back to you. You won't lose that money if your trade expires out of the money. And then your money is back with you, and you keep the premiums that you had. If the price expires below your strike price, the broker is going to use that $1,400 to buy the shares with, and they're going to put the 100 shares in your account. All right. So that there's nothing really for you to do, as long as you're trading or you're selling puts on a stock that you'd like to own. There's nothing for you to do but let it do its thing. Okay. There are immediate profits. As soon as you enter this trade, the broker gives you money. The broker, because you're selling something. When you sell something, you get paid to sell it, right? Yeah. And it can be used for weekly income. You pick a good solid stock that you have some conviction about, you can make a weekly income off that stock, either with selling the puts, and if you receive the shares, then you can sell covered calls. You're still generating a weekly income. Okay, you win in all situations except one. And the reason I say you win in all except one, the only situation this still is a no lose, but I would call it a little less of a win, is if you decide, for example, you're going to do SoFi for the $14, but then SoFi falls off the map and it drops down to $5, right? And you are still in that trade when it expires. Then you're going to receive the shares for $14, but they're now worth $5. Right. So that you still have the shares. They just aren't worth close to where you got in. So where you would, in this case, this is why I'm going to reiterate once again, when you're selling cash secure puts, that you sell them against a stock that you want to own, that you have longer term conviction about, that you'd like to be able to do, even if it's nothing more but running the covered calls, yada yada. You think it's something that you can continue to make money off of. Those are the stocks you want to use. You want to use for this. Okay. What if you don't want the shares? What do you do? Okay. So if you're getting to expiration and you see that the price may be below your strike price, but you don't want the shares, you can buy to close. You can buy to close the trade before expiration. And expiration happens at 4 o'clock, right? You can buy to close before expiration. So as long as you buy your way back out of it before 4 o'clock, then you will not get any shares. The shares are not placed on you until after hours. So if your trade is closed after hours, there's nothing for them to give you. You have to buy your way back out. Once you buy to close it, the broker still gives you your buying power back and you go on about your way. You don't have to sit idly by and receive the shares if you don't want them. If you did it for income and it didn't do what you wanted to do, then you can buy to close the trade and keep it pushing. Okay, as my daughter would say, keep it pushing. Go on to the next stock or go to a different strike price. There's things that you can do there. All righty. There's drawbacks, some cons to selling puts. I talked about this. If the stock tanks, you can kind of be left holding the bag. You're still going to have the shares, but you're going to have the shares at a lower price. But you still have an asset here. Another drawback to selling puts is they can require a lot of capital. Like I was just saying, if you're looking at a 60 strike, if you're looking at a stock that's, about $60, a 60 strike is going to require $6,000 of collateral. $6,000 of collateral or your buying power your broker is going to block away that buying power from you in the amount of $6,000. So if you like $100 stock, $100 stock, right? If you're going to multiply that times the 100, 1 0 0 and 2 more zeros, that means you put up $10,000 of collateral for each contract that you're doing on $100 stock. Okay, so selling puts can be expensive. Okay, using a lot more buying power. But I will tell you this. Big money, when I say big money, brokers, hedge funds, not ETFs, maybe ETFs, the people who got a bunch of money, they're selling puts. Warren Buffett sells puts. They're expensive, but it is a much safer way to trade than buying. Okay, this is how Warren Buffett and company end up acquiring a bunch of shares on companies that when the price drops, they end up with the shares at a lower price, especially if it's a good solid company and it climbs back up. I mean, think about people who ended up with shares of Palantir by selling puts at $14. Palantir is at 68, almost $70 right now. If anybody were to receive 100 shares at $14 and continue to keep them and hold them, they 3, 4, 5, 6 times their money. The closer the stock price comes to your put, the higher the premiums go. So the more expensive it gets. So anytime the regular price gets in proximity to your strike, the price is going to be more. So if you're going to buy your way out, you're going to have to spend probably going to spend more money than you received in premiums. You're going to spend more than you got in order to get out, if you want to get out that way. Can you put a stop on cash secure puts? Absolutely. Absolutely. You can say, okay, I received $20. I'm just pulling the number out. I received $20 here. And if it gets up to $40, then buy my way out. Yes, absolutely. You can buy your way right back out. Okay, so we talked about the pros. We talked about the cons of selling puts. Okay, here's some steps. You want to pick a stock that you want to or you don't mind owning that fits into your budget. 2 things, right? You need to have the buying power available and you want to pick a stock that you don't mind owning. I like SoFi. SoFi is a $15, $16 stock right now. I personally have good long-term vibes as it pertains to SoFi. So to sell puts on SoFi for $1,500 a week, not so bad. Not so bad at all. Now, that's just me. There's other stocks that are in the $15 and $20 and $30 range that are good, solid stocks that you might want to sell sell puts against. I've been on cover calls. It's been on my mind a lot recently. If a stock that's $60 and the 60 strike is fine with you and fits your buying power monies, some of y'all got some big accounts and you should be using that money. Those big accounts aren't doing you any good if they're just sitting there and not making you any money. Use that collateral. All right, use that collateral. in a very safe way. I'm not saying be reckless, okay? But if you got money just sitting there and it's not growing, it needs to be working for you. Let your money work like a employee, right? Pick a stock that you want or don't mind owning that fits into your budget. Chart your support levels. We spent some time in week 1 talking about how do we chart support, right? And you want to pick a strike price below that support where you're willing to pay for the shares. Below support, and you're willing to pay that price for the shares. You put it below the support because your expectation is that the price won't go down there unless you really want the shares. And if you really want the shares, then you pick a strike where you okay with paying for the shares. That took a long time to fill, and I need that back. Okay. If you're thinking about where would I find the stocks? Like, which stock would I look at? What stocks would I use, right? Where could I go find what I'm looking for? You can go to barchart.com. Barchart is a free resource, barchart.com. It does have a subscription if you want all the bells and whistles, or you can go to you can go to their main page for free. Select options from the menu. I'm going to show a graphic in a second. Select options from the menu. Select naked puts. Naked puts basically means you're not covering it with anything. Again, the first page is free. This first page gives you current price, the strike. They tell you which strike to choose. You don't have to pick that one, but they definitely suggest one. They tell you how much you're going to make in premiums if you use theirs. Expiration date, they suggest, and a BE, which was the break-even price, the volume, open interest, the implied volatility, and the delta. I know a lot of these words are things y'all don't know, but all of this is given to you on this bar chart screen. I'd suggest selecting the stock to make sure it's a buy or a strong buy. So if you're in bar chart, you can click on the stock and see that it's a buy or a strong buy. But this is what the screen looks like inside of Barchart. Okay, we're in barchart.com. Barchart is where they've got several. I'm going to show you here real quick. I got it open. I have to go there. But we're looking for options. You're selecting naked puts. And then these are the stocks that are there. This was an older graphic, but the information is still the same. You've got the stock symbol, the current price of that stock when they ran the screener. What strike are they suggesting you pick? You don't have to pick it. They're suggesting it. Expiration date, they suggest. The bid, which is the bid price, is how much you're going to potentially make as premiums. Break even percent, the volume, open interest, delta, and implied volatility. Okay. This is bar chart this is it live. If you pay for it, I don't want to say it's $199 a year, maybe a little more, but it's got a lot of stuff and it kind of has a lot of. But if you are going to use it, of course, it's worth it. I think for what they offer, $199 is a good price. This is their main page. Hope everybody can see that. This is the main page. If I make it a little bigger, okay. If you're up here, they've got a drop down for stocks. You can see all these different things talking about different stocks, top stocks to own, top signal strength, top signal direction, market momentum. They got, and if you pick any of these, the first page pops up for free. All right, they give you the first page free. I picked options. If you select options, then you've got all these other things: option screener, long call, long put, covered calls, naked put. That's where we were going, naked put. They got vertical spreads here and other things, iron condors, short calls, short condors, long condors. They've got all kinds of straddles and strangles, butterflies. They got the different things, right? Let's go select naked put. That's what we're talking about today, is the naked puts. Same thing as cash secure puts. They're naked. We're securing them with our cash. And so this ran, it says Tuesday, November 26th. Here, I think down here it's going to tell us like exactly when it was run. Nope, we don't want this. And then it populates with what they're suggesting, what could be suggestions. Now, of course, if you want more control over what the screener shows you, then you're going to need to be a member. They won't let you put any filters and all that good stuff when you're just using the freebie. None of that. But on the first page, you've got, some of these things, micro strategies here. We've heard of that one. Clean Spark is here. That's $12.50. I'm a fan of Clean Spark. QUBT, I think is that the quantum mechanics one? Quantum physics, quantum computing, that might be that one. DJT is 30, I don't do that one. Mara's 24, GameStop. MicroStrategies here is SMCI is a $34 stock, right? CleanSpark, Beyond Meats, BTBT, which is in the semiconductor space, is 350. All right. When I was saying to click on the stock to see whether it says buy or not, I'm going to pick MicroStrategy. If I hit this plus next to it, then it brings it up, and under opinion, what is your opinion? So it brings up the stuff. I'm not sure if y'all can see that. I'll try to make it a little bigger. There we go. Under opinion, which is just the opinion of the brokers that are there, it's a strong buy. MicroStrategy is a strong buy, according to the opinion of the folks or advisors who are here in Barchart. Let's say if we were looking at, what I'd say was CleanSpark here, right? We would $12.50 is the price of CleanSpark. If we're looking at what is the opinion of the analysts, what's the opinion? It's a weak sale, right? It's a weak sale. They're like, well, you maybe should, you see here, medium term indicators is a 50%, short term says hold, medium term says sell it, long term says sell it, overall average is a weak sale. Right? This is, you pick that plus next to it. I'm picking, let's do SMCI, last one. SMCI is a $34 stock. We want to see what is the opinion of it. It's a strong sale. Ooh, super micro computers. That's a strong sale. A strong sale, something you don't want to use. It's not bullish. Bullish means it's a buy, got a buy rating. So the whole thing, if you're going to sell puts, you want the price to sit flat or to go up. If it's got a rating of a strong sale, it's probably not going to sit flat or start going up. It's probably going to be going down. Okay, BTBT, you want something that's going up like that. The first one I picked was MicroStrategy, right? This is Bit Digital. I think this falls in the crypto space. It's a strong buy. BTBT is a $3.74 stock. So if you were going to sell puts against it, you could sell puts for $3, right? Maybe you could pick the $3 or the 3.5 strike, and that's going to be either $300 or $350 of collateral. Okay. All right, this is Barchart. There's all kind of stuff is in Barchart. Like I said, there's all kinds of stuff. If you want ETFs, there's all kind of things. If you want Barchart, you're going to have to go and kind of tinker around with it. Again, it's free. The first page of Barchart is free. Whatever you pick, the first page is free. All right. Okay. Now we're going to go do one. Let's go look at, I'm going to take us back to SoFi, as I talked. We'll probably go look at BTBT too, because it's a lower price. We could look at the other one that was a strong buy was MicroStrategy, and that's expensive. Okay. This is, oh my goodness. I was about to have a panic attack. Okay. So this is SoFi from, I'm in on demand. So if you have Thinkorswim, this is SoFi from August. Okay, this is back in August where SoFi was. If you have Thinkorswim is, in Thinkorswim, you can use what's called on demand. I'm up here in the top right. I'm going to make this a little bit bigger so that way you all can see it a little bit better. If you're doing on demand allows you to go back and mimic or replay or repeat the exact setup of what was happening with the stock at that particular day and time. It's a good way to do like back testing or practicing a strategy. You can go and use on demand to do that. I believe I have a video on my YouTube channel about on demand. If you don't know how to use it and you have Thinkorswim, you can go and see what on demand is all about. All right. This is back in the day when SoFi was $6. So what I'm going to do here, I took us back to this time because I wanted to show if you were selling a put, right? First thing I told you was to pick a stock that you had conviction about, which would be SoFi, could be that stock even now for some, right? You want to go and find some support, start at current price and go down to support. Support's going to be down here where it says price level 16, right? That's going to be some support. This was our place. Let me go get my annotation tool in case y'all have forgotten how to find support and resistance. All right, this is our current price that we're looking at. We're going to go from here and we're looking back down to the first place where it went down and reversed, right? That is $6.31 is where that support is. We've got some touches back here. Let you know this is possibly a good support area. Several touches that happened. So we want to pick a strike price below support. Below support. So we're going to go, let's go with the 6 strike. We're going to go with a 6 strike. Okay, below support. And now this stock is not, it's worth $16 and some change now. 15 and some change. It's not $6 anymore. So, okay, now let's go to the option chain. I'm going up here to where it says trade. Okay, so I'm on the chart. I'm leaving the chart now, and I'm going to where it says trade up here at the top. This opens up the option chain. Okay. This is August the 12th is the date that we're on. It's August the 12th. So I'm going to pick the next soonest, the next soonest expiration. And we said we liked what did we say? The 6 strike. Okay, we said the 6 strike. This was down here when the prices was low, low, low. So the premiums that you pulled in matched how low that was. How low can you go? So we can look at it from here. We can look at it from back here. And we can also go look to see what it looks like now. All right. So if we were looking at the 6 strike back here, this is against the stock is worth $6. It ain't going to do but so much. This right here would not be worth it. Okay. I want to make this real clear. If you're going to leverage, you're going to pay $2 in fees to the broker. So if all you taking in is $2, no, this is not what we want to do. But we could go out another week. Okay, let's go out another week. Maybe we pull in $7. That ain't a really doable, worth it either. You may have to go one more time. We're at $9. Again, that's it. So I want you to check the mechanics of this. Not currently that it's only $9 because I'm talking about when it was a $6 stock. So you can't necessarily expect a whole lot in premiums when the stock is worth $6. All right, $6 and some change. With $6.30, I think it was. Anyway, you would come under the bid column. If you were deciding, I like the 6 strike, I'm going to go under the bid column. This is where the sellers hang out, is the bid column. And you would select this, the $9. It says, I'm selling a put at the 6 strike. I'm going to collect $9 when I do this. All right. Confirm and send. I'm going to show you what it shows you on as far as buying power, blockage, and all that good stuff. Okay. It's going to say, okay, well, looking here. The break-even price is $5.91, which says if the price falls that low, you are at break-even. Your max profit is $9. Even though it says max loss is $5.91, it's not really max loss because you're going to get shares. So you're not, unless the share, the SoFi goes to $0, you're going to get these shares, all right? The cost of the trade is in parentheses, which means they're giving you the money. The buying power impact or buying power effect is $100, even though it would really be that $5.91. But since this isn't a margin account, it's using some of the margin money. So the broker's going to carry some of the weight. I'm going to carry some of the weight. That's what that's going. But if you didn't have enough, to be using the margin money, the broker's going to block away this other $5.91. The broker is going to block away $5.91 while this trade is going. All right. We're going to send it. Okay. So if I go back to Now the monitor tab, I should be able to see the trade. I should be able to see my SoFi trade here whenever it fills in. There we go. The SoFi trade is here. It says here, I sold. We got a whole line here that shows that I sold a 6 put. One of them, there's 18 days before expiration. I took in $9. 0.09 times 100 is $9. I took in $9. It's currently worth $9 and some change, right? P&L percentage, P&L date is basically we just entered the trade, so it's letting you know what kind of profits do we have. We don't have any real profits as of yet. Don't have any real profits because we just entered the trade. We just entered. All right. Our expiration is August the 30th. So let's go look. We're going to go take ourselves to closer to the 30th. Let's see what happened along the way. This is why I like on demand. You can go ahead and pick the day and the date and the time you want to be at and see, well, let's see what happened. You can test it out. You can enter the trades, exit the trades, see your profits. You can do all that stuff in this on demand. And you can use on demand when the market is closed. Unlike your sim, if you're using a sim, the market has to be open to use your sim. If you're using on demand, you can use on demand anytime. It's like on demand on your DVR. You can play those TV shows anytime. Now, the price of a SoFi is at $7.60-something. Okay, the current price is right here. The current price of SoFi is $7.64. See, the price came up. We started, it was $6.30-something. Over the course of the next 2 weeks, the price went up, right? Our trade price, we took in $9 is what we received in premiums. That was a +9 for us. If we're going to buy it back, it's now worth 0.005, which is, 50 cents. You can't close it for 50 cents. So let's say if we were going to close it, we could close it for $1. That means our profits would be $8. If we were to do it like that, the price has gone up. We're not going to get the shares. We're going to get to keep our premiums. If we close this, the broker is going to release our buying power and we're going to be free to continue to do what we were doing. Right? I'm going to show how we would close it. We would go to the line where the trade is. We're going to right click here, right click. It's going to say create closing order. The top one, create closing order. We're basically going to buy the one SoFi put back because we sold to open. Now we're going to buy to close and we could buy it back we're going to buy it back for $1. See, here's green. We're buying it back for $1. Confirm and send. Trade closed. They give us our $600 back. We kept our $8. Go on, go on. Okay. Let's look a little closer at what we would do if what SoFi is doing right now. SoFi is at 1549. We're going to look at the chart and see what would be a good strike. Okay, now it's interaction time from the comments. Based on our chart, let's find our support levels. Can y'all see that? Do we see some support? Stephanie, that's just when I make a line, I left it where there's the writing that shows price level. I had it to show the writing. So if I write things in there like support, resistance, so if I write something in there, then it will show up on the right hand side. That's all that is. Good go here. Y'all think there's some support in here? Let's change our style to align and see if we see some support in here. Nope, there's no support. That's all momentum. If you're looking closer, oh, here's some. Here's a support. wherever there's a peak or a valley, there could be that's a place where price went and turned around. Oh, I didn't want that. I wanted a line. It's going to be something in this area. Okay, then I go back under style, chart type, and turn it back into a candle. Right here, the price went up here and pulled back, went up some more. A support can become resistance. A resistance can become support. This was resistance here. Now, if the price comes back to it, it is support. So that is 14. I'm going to show you what I was talking about, Stephanie. If I double click this line where it says price level 17, that I have it written here. I could put this as support. Let's say I put daily. So if I was writing things on my lines, if I don't write anything in there, it just puts the words price level. Okay. 11 is one. Yep, that's pretty far away. We want to see about support that's close by. So we're thinking, where would we potentially sell puts? All right. Looks like we've got some at 14.14. So let's go look at the option chain to see what about selling some at the 14 strike. Now, this is for a couple of days from now. So, of course, there's no money here for 2 days from now. No, right? So now let's go out a little bit further. This week is so low on volume that there's not a lot happening here, right? 14 next week, paying $10. Remember, though, you got two things you're using cash secure puts for, one of two things, right? You're using it to acquire the stock if you want to acquire it at $14. Maybe you say, I'm fine with acquiring it at $15. So I go to the 15 strike. Like, well, at the 15 strike, it's paying $34. I'm fine. You may be saying, I would be fine with buying it for $15. If that's the case, that means you're going to take in $34 of premium and you're going to utilize $1,500 of collateral. Okay, I'm going to select this. Remember, we're in the bid column. I'm going to select this. You could have picked 14.5 as well, by the way. You don't have to be whole numbers. 14, 14.5, 15. You can check the delta. The delta here is 33 delta, which is a 67% chance that it's going to be down here, that it will expire beyond here, below here. Okay. This is delta of 22 for 14.5, might be a little more, likable. If you didn't want the shares, if you do want the shares, then you're fine with that. You're fine with it coming. You get the premium right away. The broker gives you the money right away. You can do whatever you want to do with it. So we're selling a put against SoFi, 14.5 strike. The price we're going to collect is $19. Okay, so if I was to push confirm and send, it doesn't like that. Why doesn't it like that? I'm not sure. Oh, it says illegal. I wonder why it says that. Maybe. No. Anyway, you would be selling a put against here. $19 is what you're going to receive. The broker is going to block away. If we've got 14.5, how much money is the broker going to block away? 14.5 times 100. The broker is going to block up 1,450 of your dollars for each contract. And you're going to take in $19 for each contract. You could say, one is, as you multiply, if you want 2, 3, you want more money for premiums, you're going to have to put up more collateral for your cash secure puts. Okay, that's how that goes.